Almost everything you've been told about trading is false. It's not about all these gimmicks and tricks. Trading isn't about signals. It's not about indicator overload. And it certainly isn't about scalping with tiny time frames. Sure, gimmicks and tricks can work. Sometimes. Signals and indicators can also work. Sometimes. And if you flip a coin, it can sometimes end up on heads. In fact, if you've tried any or all of these so-called trading hacks and have found some success, it likely wasn't long before your results became inconsistent and taking trades felt more like flipping a coin, trying to predict when it would land on heads. You see, I found that long-term trading success is about having just one key strategy that you can learn, master, and implement day in and day out. So today, I'm going to show you the strategy that made me over $110,000 of trading in the last 30 days alone. It's also the exact same strategy that helped hundreds of students that I teach generate a 132% return on their trading accounts during this exact same time frame. I call the strategy the purist approach. Now, before we get into this, I'm not some trading guru know-it-all. In fact, less than 3 years ago, I was probably in the exact same position you are in now. I knew virtually nothing about trading. I don't have a finance background, and I didn't religiously study the market for years. However, in less than 2.5 years, absolutely everything has changed. And in less than 18 months, making over $100,000 per month. And you want to hear something even crazier? I did all of this by working just 1 to 2 hours per day, because trading is actually really, really simple if you do just one thing: manage your emotions. I'm going to explain exactly what I mean later in this video, but for now, let's delve into the strategy. I mentioned before that I call this strategy the purist approach. And the reason I call it the purist approach purely focuses on price action. Now, what do I mean by that? Behind me, I have the 5-minute chart of SPY. SPY is the ETF of the S&P 500, and it's the only ticker that I trade with this strategy. A couple things that you'll notice about SPY's price action, particularly on the 5-minute chart: price will distribute up, it'll distribute down, but more importantly, it'll distribute through a particular price range. What do I mean by that? You'll notice that when price distributes up and it changes directions, it tends to run into what we call resistance, almost to the penny a few times. In this particular case, I'm looking at the pre-market action. I noticed that price tested and failed to close above 596.25 1, 2, 3 times. At that point, I knew that would be the upper bound level of price range in pre-market. What happened next? Price came down, it tested, and failed to close below 592.82 1, 2 times. At that point, SPY's price range was going to be between 592.82 and 596.25 for that particular morning. When price opened in the open market, what we looked for is for price to confirm that either the upper bound level of resistance or the lower bound level of support would be tested and price would fail to close above or below. What happened? Price opened, it came back up, it tapped the upper bound level of resistance at 596.25 to the penny. At that point, we predicted that if we could get a 5-minute candle close above the upper bound level of resistance, price would distribute up into a new range. How can we predict that? Well, the other unique thing about price action is that when you confirm upper bound level of resistance or a lower bound level of support, once you get a 5-minute candle close above resistance, that same level tends to act as the new lower bound level of support for the next price range. Price tested it as resistance. We had a 5-minute candle close above it, and then price tested it as support and distributed up. This is the hallmark for what we look for in taking entries on option. Let me give you another example from this exact same day. Once price distributed up, it found a new level of resistance up at 597.97. At that point, we marked that level as our potential upper bound for that price range. Price came back down. It did not test that same level of 596.25 as support. It came back up and then came back down. At this point, it did in fact test 596.25 as support 1, 2 times. At that point, we pulled up our put contract. And if we could get a 5-minute candle close below support, we would take entry on put. What happened in the next candle? We had a 5-minute candle close below 596.25, and we took some puts. At that point, we would predict that price is back into the original pre-market range. And if price came up and tested 596.25, it would be as resistance. It would reject it and push price further down into the original price range. And that's exactly what happened. Another example, once price distributed down, we predict that it would test the pre-market low, which was our original price range, and reject it. At that point, we were looking at put contract. However, price came back up, back down, and then distributed up towards the top of that original price range. And what we were looking for at that point is a 5-minute candle close above 596.25 once again. And if we could establish another 5-minute candle close, we would take calls once again. So what happened at that point? We had a 5-minute candle close above 596.25. Price came back down, tested it again as support, and pushed price back up to the top of that second price range. So on this particular day, what we did is step 1, look for the current price range that SPY is trading in. Step 2, wait for price to confirm either the upper bound level of resistance, the lower bound level of support, by testing it at least once and failing to close above. If it's testing resistance, pull up your call contracts and wait for a 5-minute candle close above resistance. If it's testing support, wait for a 5-minute candle close below support and pull up your put contracts. Now, on this particular day, we took 1, 2, 3 entries, 2 calls and 1 put on the exact same key level. And on this particular day, we made over $10,000 trade. Does this strategy work 100% of the time? I'll be the first to tell you absolutely not. In fact, if anybody tells you that their strategy works 100% of the time, they are 100% of the time lying to you. But here's the beautiful part. It doesn't have to work 100% of the time. In fact, it doesn't even have to work 80% of the time. And here's why. Remember earlier in the video when I talked about the one thing that makes trading really, really simple, and that's managing your emotions? Here is where I want to get on to part 2 of this strategy and this system. If you combine this strategy for taking entries on option with an emotionless risk management system that prevents your losses from being greater than your wins, you will be successful long term as long as your strategy works just 60 to 65% of the time. Let me show you how that works. So on this particular day, when we were looking at call contracts, we looked and waited for price to confirm this level of resistance that we saw from the pre-market. Once that happened, we went to our brokerage account and we looked at option 1 day to expiration, priced between $1.30 and $1.70. At that point, we waited for a 5-minute candle close, and when it closed above resistance, we bought calls. Here comes the risk management system. We noted the price that we've got filled at on our calls. We immediately put in an automatic stop loss at 10% below that price. If price had moved against us, the most we could lose on that trade is 10% of what we risk on that particular trade. However, if price moves in our favor, we wait for that price to move 10% above where we bought contracts, and we sell half our position and move that stop loss to break even. At that point, your trade is going to be a green trade no matter what. Next, if price continues to move in our favor, once contracts get to be worth 15% of where we bought, we sell another quarter of our position and we move our stop to 10%. At that point, that trade is going to be worth more than 10% and worth more than any trade that moves against us. Finally, if price continues to move in our favor and it reaches 20% above where we bought, we sell in full. At that point, we call it a full trade, and those trades tend to net about 15 to 18%, significantly above the most we could lose on any trade because of our automatic 10% stop loss. Let me give you another example. On this particular day, we looked at pre-market price action, and we noticed that SPY traded up and found some resistance at about $5.99.45. At that point, we marked that level as potentially significant. And then SPY moved a little bit further up and tested $5.99.92. We also marked that level as a potential key level of resistance. We thought about getting rid of this first level. However, we saw it respected again after pre-market moved above it. And so we left that level on just to see how current price would react to it. Price moved down and it reacted to $597.49 as support. We now have SPY's current price range based off of pre-market action once again. And so we wait for the market to open, and what happened? Price immediately moved down and tested that predicted level of support at $597.49. It failed to close below it, and it moved back up into the pre-market price range. As it did that, we waited to see what would happen when price reached $599.45. And what happened? It reacted and failed to close above it. At that point, we started looking at some calls. However, since we had another, what we call overarching level of resistance, not far above that $599.45, we were going to be cautious in this particular smaller range. And so once price closed above $599.45, we thought about taking call, but we wanted to see what price would do at $599.92. So we held off, and we noticed that price did come up, test, and react to $599.92 to the exact penny. However, it did come back down, test $599.45, which was resistance, now as support, which is exactly the type of price action we were looking for. So on the next candle, we were waiting to see if price could have a firm close above the pre-market high of $599.82. At that 5-minute candle close, we bought calls, placed an automatic stop loss 10% below the price we bought contracts at. Price ended up moving in our favor, and when those contracts were worth 10% more than what we bought, we sold half of our position. We moved that automatic stop loss to break even. At that point, that was a green trade no matter what. Price continued to move in our favor. And when price reached 15% above where we bought calls, we sold another quarter of our position and moved our automatic stop loss to 10%. At that point, that trade was going to be worth more than if that trade had moved against us completely. In this particular case, price continued to move in our favor, and when price reached 20%, we sold the contract in full for about an 18% gain, almost double what would have happened if price had moved against us. And that's it. That's the strategy. That's the system. The key thing is being consistent, never stray away from your emotionless risk management system. Continue to test and ensure that your strategy is successful at least 60 to 65% of the time, and that you never, ever let emotions get the best of you and do not implement your automatic emotionless risk management system. If you can do all of this, you can stay consistent, you can manage your emotion. Over time, you will be a long-term successful trader. If you got a lot of value out of this video, subscribe to my channel. I'll be posting content once per week, and I'd love for you to come along and learn more about my options trading journey. Thank you very much.